The stock market can seem like a big, scary place, but don't worry, it's simpler than you think. Imagine a giant shop, but instead of clothes, they sell pieces of companies. These pieces are called stocks. When you buy stock, you become a part owner of that company. It's like getting a tiny slice of a giant pizza. Companies sell stock to raise money. They use this money to grow their business. Why do people buy stocks? They hope the company will do well. If the company does well, their stock price goes up. Then, they can sell their stock for a profit. Of course, there's risk involved. If the company doesn't do well, the stock price might go down. That's why it's essential to do your research and invest wisely. Remember, investing in the stock market should be a long-term game. Don't expect to get rich quick. Be patient, and over time your investments can grow. Now let's talk about stock exchanges. Think of them like giant marketplaces. This is where buyers and sellers come together to trade stocks. Two of the most famous stock exchanges in the USA are the NYSE and the NASDAQ. The NYSE is like the old-school market where traders shout and make deals on the floor. The NASDAQ is more modern with all the trading happening online. But how do we know how the market is doing overall? We use stock market indexes. Think of them like report cards for the market. The Dow Jones Industrial Average, DJIA, is like the popular kid in school. It tracks 30 large, well-known companies. The S&P 500 is like the brainy one. It tracks 500 of the largest companies. And the NASDAQ Composite is the tech-savvy one, focusing on technology companies. These indexes give us a snapshot of how the market is performing. Just like there are different types of pizzas, there are different types of stocks. Let's explore a few. Blue chip stocks are like the classic pepperoni pizza, always a safe bet. These are large, well-established companies with a long history of success. Think Coca-Cola or Johnson & Johnson. Growth stocks are like the new, trendy pizza place everyone's talking about. These companies are growing rapidly and have the potential for high profits. Think Tesla or Amazon. Dividend stocks are like the pizza place that gives you free breadsticks. These companies share their profits with investors by paying dividends. It's like getting a little bonus just for owning the stock. Remember, each type of stock has its own risks and rewards. Diversifying your portfolio with different types of stocks is important. Section 4. Navigating the stock market trends, strategies, and indicators. The stock market is like a roller coaster. It has its ups and downs. Understanding market trends and having investment strategies can help you navigate the ride. One popular strategy is buy and hold. It's like planting a tree. You buy a stock and hold on to it for a long time, letting it grow. Another strategy is diversification. Don't put all your eggs in one basket. Invest in different companies, industries, and asset classes. It's also important to manage risk. Don't invest more than you can afford to lose. And remember, past performance is not indicative of future results. Economic indicators can give you clues about the market's direction. GDP, unemployment rates, and interest rates are just a few to watch. Section 5. Taking the plunge. Starting your investment journey. Ready to start investing? Great. The first step is to open a brokerage account. This is like a bank account for your investments. Once you have an account, you can start buying and selling stocks. You can place trades yourself or use a financial advisor. Remember to do your research before investing in any stock. Look at the company's financials, understand their business, and consider the risks involved. Investing in the stock market can be a rewarding experience. It's a chance to grow your wealth and participate in the economy. Section 6. The importance of regulation and market integrity. The stock market is like a game, and like any game, it needs rules to make sure it's fair. That's where regulatory bodies like the SEC come in. The SEC is like the referee of the stock market. They make sure everyone plays by the rules and that investors are protected. They prevent fraud, insider trading, and other illegal activities. This helps maintain market integrity and investor confidence. Remember, investing in the stock market always carries risks. But by understanding the basics, doing your research, and investing wisely, you can increase your chances of success.